You're listening to Lighting Up Real Estate with your host, Kendall Lockett.
If you're planning to purchase your first property or first home in 2021, you are going to need credit as a part of your financial power. Credit allows you to use other people's money instead of your own. In episode 3 of Lighting Up Real Estate, CEO of HTP Enterprises Financial, Nicholas Antoine, shared his credit secrets. Now let his company help you build wealth with credit. HTP Enterprises Financial is the company that will improve your scores by erasing negative items, bankruptcies, delinquencies, and more. I'm a personal client of HTP Enterprises Financial and have referred my clients and friends to this company. You get results. So I partnered with HTP Enterprises Financial to offer my listeners $100 off any plan you choose. Just go to the link in the show notes using promo code LightingUpRealEstate. Make 2021 the year you use credit as buying power. Episode 34. Today we are lighting up tax strategies for real estate investors. As always, the goal of this show is to shine a light on people, strategies, systems, and ideas to help you grow your real estate investing business. On the show today, we have tax strategist Michel Valbrun, who is here to help us build wealth through real estate and change our mindset about how taxes actually work for us and not against us. We discuss tax incentives for flipping, Airbnbs, landlording, the 1031 exchange, creating LLCs, and how to know if we even need a CPA. He also gives us insight on what to expect with the new tax codes with the Biden-Harris administration. This is a lot to unpack. Let's get started. Michel, welcome to Lighting Up Real Estate.
Thank you so much for having me. It's an honor.
Oh, wow. It's an honor to have you. I'm going to be honest. I'm just going to give a disclaimer before we even get started. I'm not a fan of taxes. So even having this conversation, I feel like I need to pull out a calculator and get my big box of receipts. I feel like I need to already. We hadn't even started the conversation yet. But I wanted to definitely get you on the show because this is the elephant in the room. Like we always talk about investing and building wealth through real estate, but we don't talk about the most important part of when we start making the money and the wealth. We got to share it with somebody. And and that person is the government through taxes. And I definitely wanted to have you here so you could break this down for us, beginning real estate investors, like what to expect when we're getting these properties, all that good stuff that that we don't know or we choose to ignore and we don't need to ignore. And what can happen when we ignore.
Right.
Uncle Sam. So let's get started. Where do we even begin when we start having a conversation about taxes and real estate?
There's a couple of places, but typically I think the most important thing is for people to realize, and I think you did a great job at introducing this idea and concept of how taxes is pretty much a big deal for everyone, right? We all have to deal with taxes. And when you look at the tax code, it's pretty complex. There's over 70,000 pages in the tax code, and it is a lot to digest, and really people have a tough time dealing with it and they struggle with it. So really, I mean, for you and for anyone who's starting off, don't feel terrible or don't feel bad about not knowing it. It is complicated, but I will tell you this, if we were to break down the whole tax code, if you really look at it, it incentivizes and it's really geared towards and benefits entrepreneurs and business owners. So if you are a real estate investor, if you are an entrepreneur, there are several tax benefits that are going to help you reduce your taxable income because the government sees that as a way that it's contributing to society. So as a real estate investor and as someone who is purchasing property and doing things related to real estate, you're providing housing, you are creating, spurring and spending money in the economy, right? You're getting loans, you're doing all these other things, you're getting tenants. So the government wants that because for them, it takes some pressure off of them so they don't have to find and provide housing to individuals. So really, as it relates to that, you guys are in the right place to be as a real estate investor. And that's usually where I think the most and the biggest thing that people need to understand is, like, if you're not already real estate, get into it, because that's where it's at for sure.
Because we're solving a problem.
You're solving a problem for the government. So take advantage of that. Yeah.
Okay. So this is all pretty much what you're just saying. It's a complete mindset shift that you just put me in.
100.
I love it already.
Yeah, no, it's
Okay.
yeah, people, and this is the thing about it too, right? So, and then, not to get to political, but people are upset with Trump paying the 750 in taxes and all that kind of stuff, but
Yeah.
he's doing activities that the government sees as beneficial to society. Amazon, Apple, all these other companies who are reducing their tax liability legally and ethically, it's because the government kind of gives them breaks and incentives to do it. So when people aren't paying money in taxes and are doing so
Mhm.
legally and ethically, yeah, I think honestly the mindset shift is like it's because the government in their eyes sees this as a beneficial activity to society, and
Mhm.
then they get to reap the benefits of doing that.
Wow, okay, now this is the question though, like, for those that aren't in real estate investing, like, I was a kindergarten teacher,
Uh-huh.
and that mindset of being a teacher, I'm like, "But I'm contributing to society, like, how come I don't get the tax benefits?" And I was teaching
Right.
that, and so one would probably be offended by that, but, I mean, it's the truth though. You have to have businesses to get the benefits, but
Yeah, it's it, and again, that's more of like that's what the government deems as important. But no, for
yeah,
me, obviously, for me, I think education, people teaching our children, all that kind of stuff, is a huge benefit to society, and I think they should be rewarded for that. But unfortunately, the government's
yeah,
more interested in people who are generating money and
money, yeah.
in commerce. That's where they're at.
Yeah,
with it.
and it's black and white. I mean, I'm glad you said that because I mean, that way it's clear. It's not like it's our personal beliefs or feelings. This is
Right.
what the government has already established. This has been going on for centuries.
Yeah. Uh-huh.
So
Exactly.
so right now, you're just telling the truth, and the truth is gonna set us free today.
That's right.
This is why we need to own real estate.
Big facts, yeah. And this is the thing about real estate too. So not only are you getting, contributing to society, right, by providing housing and having tenants, but then yeah, there's some significant tax benefits of
Mhm.
doing that as well. And it's also an amazing way to build generational wealth. So I mean, there's just so many benefits. So no, it's awesome again that you're providing this knowledge out here to people and really getting people excited about getting in the space.
Okay, so how can real estate work for us? If we're owning, does it matter? Let's just start there. How does real estate work in our advantage? And then we're gonna go into the different strategies.
Yeah. So taking a step back, so when you say real estate, that can mean so many things, right? So,
Yeah.
and there's so many different categories and different tax implications of real
Mhm,
estate. So let's start off with the very, very basic home ownership, right? So if you own a home and you are a homeowner, there are certain tax benefits for you. Let's say you're just a
mhm,
W-2 worker working a 9 to 5 and you have a home. So tax benefits that you can take advantage of is your itemized deduction. So if you look at your itemized deductions, which is Schedule C, or sorry, Schedule A, on that itemized deduction, you're able to deduct a portion of your property taxes, mortgage interest, several other categories as it relates to real estate and home ownership that you could be able to
mhm,
take advantage of. So that can help increase your itemized deduction. If you don't know, if your itemized deduction exceeds your standard deduction for a single filer for 2020, for this upcoming tax season 2021, the standard deduction now is 12,550. So if your itemized deduction exceeds that amount, then you are able to take a bigger write off for you. So that's number one. So again, that's again encouraging people to be homeowners as well, because homeownership is a great thing that the government appreciates people doing, is owning homes. Now,
okay,
taking it to the real estate side, right? And there's so many different things. When you look at real estate, we have fix and flips, we have rehabs, we have
mhm,
Airbnb, we have residential properties, we have commercial properties, we have a full spectrum of what can be done.
yeah,
And to really simplify it and break it down, there is what's considered operational income or active income, and then you have passive income, and they have
okay,
two different tax classifications and how they're treated and done. So, operating income or active income would be income typically that you would make in less than a year. So, or you would or it requires some kind of effort from your end. So, for instance, if you're doing a fix and flip, typically you could do that within a year. The money that
mhm,
you make would be considered active or operating income. An Airbnb, for instance, that would be another situation where you'd be considered operational type income. Airbnbs, rehabs, just like a fix and flip. And then on the other side, you have the investment income, which is more like residential properties. When you own property and you have tenants and they're paying you money throughout the year, you're getting that cash flow from them. So that's kind of the way it's separated. So on the operational side, typically what you're going to find is that because it's active income, you're
Mm-hmm.
going to want to be aware of making sure that you put that in the proper entity structure. All right, because what ends up happening is, because it's active income, you're going to be either taxed at, you're going to have to deal with things such as, like, basically you'll deal with having to make sure that you have the right tax entity for your business. So for instance, let's say you're doing a fix and flip business,
Mm-hmm.
you're going to be responsible for those taxes during the year. So you have to pay capital gains tax, and this is what you have to pay on. Yeah, this is what you have to pay on
Yeah.
the investment side too. So because you're going to have a ton of capital gains, it's going to be less than a year. It's going to be taxed as short-term capital gains. So you're going to have to be taxed at it's going to be taxed as ordinary income. So one of the things that you want to look at doing is, one, making sure that you're taking full advantage of the expenses as it relates to those that type of those type of investments. So you're looking at
Mm-hmm.
things on, like, advertising, potentially repairs and maintenance. And there's a full list on, if you go ahead and look at Schedule D, I believe, then you can go ahead and take advantage and look at all those expenses that relate to it. So that's one side. And then on
Mm-hmm.
the other side, on the investment side, you want to make sure you have, like, a separate LLC for those, so legal unlimited liability company, and that's going
For
to.
each property that we flip, or just for that, for our business?
So there's two ways you could do it.
Okay.
If you're just starting off, I think it's okay to do it within one LLC, but as you continue
Mm-hmm.
to grow and expand your portfolio, it's recommended to do multiple LLCs to give you more protection. Because what's going to happen is, if someone were to come sue you, like, let's say you have a tenant in there and they were to slip and fall, or whatever the case is, or a scenario that I heard of is, like, maybe the pool turns green and their kid happened to swim in it, or whatever the case is,
Yeah.
then if they were to come sue you, one, as long as you have that LLC structure and you've been being compliant with the requirements of the LLC, which is not commingling funds, really showing a
Mm-hmm.
separation between you and your business, then you don't have to worry about your personal assets getting touched. So that's one. But then also, two, they would only have access to what's within that LLC. So if you have multiple properties within that LLC, then they would be able to sue and be able to potentially get the money from everything
Wow.
in there. So a strategy that people do is they do create multiple LLCs to separate
Mm-hmm.
and create more, separation between them and their business. And only, if someone, like, let's say that you have one property, it can only come after the income from that one property.
Oh, wow. Okay, so and I've heard this too, and I think on another podcast, it was an investor, and it just stuck with me because he said that it was two guys, and one guy was like, "Yeah, I have, for every property I have, I create an LLC and I use a street address." And I was like, "Okay, that's a dope idea."
Uh-huh.
Yeah, 23 Smith Street LLC. I got it. But then the other guy was like, "You're crazy because you're giving more money to your tax preparer because they're going to charge for each LLC you have." Is that true?
Yeah. So it's more work. So it's a balance. You got to figure out, like I said, when you're starting off, I think that's fine. But then
Uh-huh.
as you continue to expand and grow your business portfolio, then maybe it makes sense to create multiple LLCs. But yeah, no, you're right. So each of those businesses would have to be reported on a separate tax form.
Wow. Every year.
Yeah.
Wow.
Every year, as long as you have both
Wow.
properties. So yeah, I think it's really a balance between figuring out what's your preference.
Mhm.
Do you want to keep things simple? I think the most simplest way to do it, and again, I think it's a fine way to do, is just keep it under one LLC, as long as it's related to real estate.
Mhm.
Then I think that works. But then again,
Okay.
if you really want to get really super protected on your assets, or whatever the case is, then you could create multiple
Okay.
LLCs.
That was a great point you just said. So as long as it's related to real estate. So I can't have like Happy Incorporated or Happy LLC, but have my real estate businesses in it and also my Shopify store in it
No,
and
no, 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 no,
none of
no,
that.
none of that. No, that's got to go. You can't.
Wow.
So this is the reason why. So you
Mhm.
have your separate LLC, and basically when you go to file your taxes, and you may be aware of this, like when you're going to set up like your EIN and everything, they're going to ask you what's the business code. When you go to do your taxes, what's the business code? So you actually use that business code to be able to audit people, and it's computer automated audit. So basically what the computer is going to do is it's going to look at, okay, what do people typically make in this industry, how much are they spending in these particular categories, and they're going to bump it against their system, and if there's any significant outliers, then your tax return is going to be flagged and potentially get picked up for an audit. So you do want to make it separate, and
Mm-hmm.
then really it's just going to help you from an accounting standpoint too, to be able to track everything. Because let's say you have, your Candle property group as an LLC, but then you have your podcast in there as well. I mean, you're going to have specific expenses that you can write off for the podcast, specific expenses that you can write off for your real estate company, and it's just going to make everything confusing. Because like, you can't, for a real estate business, it doesn't make a ton of sense for you to be able to write off a microphone and headphones and a Libsyn account if that's what you're using to distribute your
Right.
podcast, versus your podcast doesn't make sense for you to write off for expense, repairs, management fees, and all those kind of things. So that's why it's important to have that separation. And even another important point too is to make sure that you have a separate business account for those too.
Oh, wow. Okay, but do they have access to our accounts? Like,
So the IRS doesn't, not necessarily, but if they wanted to like garnish, start taking, like if you're behind on your taxes, then yeah, I mean they can potentially go in and start taking those things. But no, yeah, they're not gonna have. It's really to, again, it's really to create that distinction between
mhm.
yourself and the business. So it shows you everything is separate, and then also too to keep everything organized from like a accounting perspective. So keeping the expenses and
Wow.
the income within the
Mhm.
same bucket.
Okay. So, what about if you are just a landlord?
Yeah.
How does it work when you're keeping the property and you're not selling it?
Yeah, so if you're keeping the property, you're a landlord, so that's going to be more of on the passive income side of
Mhm.
things. So what you can do is you can be able to take off and write off for things such as depreciation. So depreciation is an amazing tax
It
benefit
is.
because it's a cashless expense for the business. A depreciation, if you guys don't know, is an expense, and it's pretty much you writing off the property over a certain period of time. So if it's a residential property, that's 27.5 years. If it's commercial property, it's 39 years. And you pretty much get to write off the value of that property every year. And it usually, what ends up happening is that you end up showing that you have a loss on the property, even though your cash flows are more than that. So if your net
Mhm.
cash flow, let's say you're doing like a $500 to $1,000 per month on net cash flow, it still may show as a loss depending on the value of the property.
That's so dope.
Yeah.
I think that's the dopest strategy.
It is. It's incredible. That's what I'm saying.
Yeah.
It's almost like, again, they do that to incentivize you and people to invest in
Mhm.
real estate.
Yeah. Can you talk about, I think this is a crazy strategy that we don't talk about. And I also have my real estate license. And when I was working with clients, I would try to get them to fix and live in the property and then eventually sell it. Cause I'm like, okay, if y'all don't want to stay in the house, sell it. In 2 years, you're not paying
Mhm.
any taxes. And
Right.
they're like, there's no way. And I'm like, yeah,
Uh-huh.
trust. Like, can you please explain that?
Yes, if you're talking about, it sounds like you're talking about the home exclusion on the gain.
Yes.
Yes.
Uh-huh.
So what the IRS allows you to do is you're able to exclude the gain. So typically, if you sell a property for more than what you pay for it, then you have to pay what's called capital gains tax. So there's a
Mhm.
home exclusion that the IRS does, again, to incentivize people to be homeowners, because they know that if a regular person, W-2 employee, purchases a property, chances are it's going to go up in value. Let's say it goes up in value by 200, and they sell that property, the capital gains tax will probably be between 15 and 20%. Let's just say, just to keep the math simple, let's call it 20%. That individual will be responsible for $40,000 worth of taxes, right? So they
Mhm.
know that's going to be a huge deterrent from people investing in, and getting a home. So they're just like, okay, this is what we're going to do. We're going to go ahead and give you a break. And if the gain is less than, I believe, 250 for a single individual and 500 for married filing jointly, then that amount of the gain could be excluded for tax purposes.
Yeah. It's
It's
incredibly
beautiful.
dope.
Yeah.
So
And
that means you just sell it and you keep all the money.
right. And then what people do too is yeah, that's yeah, people do that as long as they meet the requirement. I think it's
Mhm.
want to say it's 3 years
Yeah.
to stay in the property. As long as it's based on out of the 5 years. So you can have the property for 5 years as long as you lived in that property that's your primary residence, I believe, for 3 out of the 5. Could be two, but
Yeah.
just to be safe, 3 out of the 5.
Yeah, I was told it was 3 years,
Okay.
and then you can sell it. Yeah, I think it's just yeah, that's the coolest strategy. I bought one of my last properties doing that same strategy, but I ended up keeping it.
Mhm.
But I'm like, gosh, the
Well,
strategy is dope.
Well, this is the thing too, and then I think that brings up a very good point too, is like knowing about that stuff up front too, because what ends up happening is that I run into clients and I meet people who don't know these
Mhm.
things, and then they try to sell something and they owe all this tax, and they're just like, well, what can I do to reduce? I'm just like, you can't. I mean,
You can't.
you didn't do what you were supposed to do. You know what I mean? Not saying
Yeah.
it's impossible, but now I'm gonna have to come up with some creative strategies
Mhm.
and other things outside of the home exclusion that you already had. You already wasted that, so now we got to come up with some other things to try to reduce that tax liability. But that's the important thing. That's with my company, that's what we focus on, is helping
Mhm.
individuals, entrepreneurs, business owners proactively save $10,000 to $100,000 in taxes legally and ethically. And it's giving them that upfront information and laying out to them, like, these are all the strategies that are available to you. So now this is going to potentially impact the way you operate now and look at things a little bit differently. But yeah, having that information up front is key.
Yeah.
It's
So,
knowledgeable.
it is definitely possible that you could save up to $10,000, and keep that money.
Yeah, 100%. I know it sounds. I'll give you. So we
Yeah.
talk. Let's say the home exclusion, right? So like I gave you the
Mhm.
example,
Yeah.
200,000, $40,000 you would have paid in taxes because you didn't know what you didn't know. But now that
Right.
you have that strategy in your pocket, even that strategy, that's like a $40,000
40,000.
savings. Yeah,
Yeah.
that you would have ended up paying by not knowing. And people pay it
Yeah.
all day, every day because they just didn't know.
Yeah, they just don't know. So is it better to before we even get a house or I mean, not even our to live in our primary residence, but even an investment property, should we already have our tax preparer or are you already on our team? Just give us the strategies before we even start looking because that's something I mentioned in my course is that you need to have your accountant ready. Tax.
Oh yeah, no, 100%. Yeah, there's several instances and life events that you need to have like a CPA on your team.
Mhm,
Investing and home ownership is going to be definitely those two big categories. And then one thing I wanted to share too is like there's a one to make the distinction between a tax preparer and a tax strategist.
mhm.
So as it relates to taxes and just the tax profession in general, like there's levels to this, right? So there's like different categories of tax professionals out here, right?
Did not know this.
Yeah, so
Okay.
I'm about to like really give you some game on this. So check this out. I'll share a personal story, true real life
Okay.
story. So I'm going to school. I'm studying accounting. I'm going to like the top 10, top 15 university in the country as it relates to accounting. So totally
Mhm.
legit school, not an online program, or it's like a real school, right? So
Right.
I'm going to the school, and then as I'm going to the school, and volunteering for this organization. It's called VITA. Basically, what they do is they help lower income individuals do their taxes for free. And I was doing this work and just kind of getting my feet wet and kind of learning the game or whatever. So I'm doing taxes for folks, and I come across this couple, and they have a small business, and it ended up owing a little bit of money. And once I completed the tax return, the husband turns to me and is like, "Well, how can we save money next year?" And I froze. Like I didn't know what to say. I didn't know what to tell him.
Wow.
And again, I'm going to school to learn this stuff. And the thing about it is the school pro or the education program, at least from my experience, it
Mhm.
really prepares you more to work in corporate America, helps you work with large corporations, and it doesn't really educate you on the different tax strategies that are available to small businesses, to investors. It's really like, how do you account for these transactions, debits, credits, federal tax rules, those kind of things. So I had to invest, hundreds of thousands of dollars to learn this information. I worked with the
Mhm.
top tax experts in the country's attorneys. So, and again, this is me on my track to becoming a CPA. This is me working once I graduated, actually interned, and then became working full time at one of the top 4 accounting firms in the world. So,
Mm-hmm.
but even with that knowledge and background information, I still don't have this information. So I had to go ahead and invest in myself to be able to get it. So when I say the levels, you have different levels. So the lowest level, and again, this is my personal experience, what I've
Mm-hmm.
seen in the industry. So the lowest level is tax preparer. So tax preparer is an individual that submits your tax return to the IRS. And to be a tax preparer, there is really no rules or regulations around it. As long as you have what's called a P10, which is pretty much a preparer tax identification number, you can go ahead and pay
Mm-hmm.
taxes. Kendall, if you want to go on Instagram and say, I'm a tax preparer, I'm gonna do y'all taxes, you can do that. And there's nothing stopping you from doing that.
So is this like a H&R Block type of?
I was just about
Okay.
to get into it. So if you go on the H&R Block website,
Mm-hmm.
you'll see that the only requirement for you to be able to join their income tax program is just pretty much a course they take you through before you start working there. Is all you have to do
Wow.
is to be only requirement is that you need to be 18. You don't need to have a high school degree. Don't need a GED. 18 years old, you're good to go.
Wow.
Right. And that's me. And I'm sure they have a little bit more of a rigorous process, but
Mm-hmm.
it's not like it doesn't take much to be able to prepare people's tax, especially when they have it systemized to where it's really like a questionnaire. Like if I don't know if
Mm-hmm.
you've used TurboTax, but they'll ask you questions, you put it in there,
Yeah.
and it pretty much does the work for you. So they're just like, I mean, we don't need a CPA to do this. We can just have some kid come in here or someone who does hair on the side and they're just looking to make some extra money, whatever the case is. And
Mm-hmm.
that's what it is. And I think, I mean, and I love the fact that, people are out here, they're making money, they're owning businesses. So, it's not a knock to them, but that's just as a business owner, as an investor, just putting that information out there for you. So then the next level above that, it is an enrolled agent. So an enrolled agent is an individual who passed a 3-part exam with the IRS. So the IRS has an exam for you to be what's considered an enrolled agent. Enrolled agents are very technically proficient in the tax law. They know a lot as it relates to taxes. And, to be an EA, I believe the process is like, 6 months or whatever. You could probably knock it out within 6 months to a year to be an EA. And there's no degree or any other educational requirements. So it's kind of like getting a real estate license, right?
Mm-hmm.
So you go ahead, you take the exam, but again, you do learn a lot, and you do become technically proficient in tax code. So those are enrolled agents. Then the higher level of that is the CPA. I say the CPA is higher because in order to be a CPA, you have to have 150 credit hours, meaning you have to have a bachelor's and a master's. You have to pass a 4-part exam, which less than 50% of people pass, and you have to work under a CPA you have to work with a CPA for at least a year, under a CPA with at least a year, and they need to sign
Mm-hmm.
off that you worked under them. So it's a lot more of a rigorous process to be able to become an enrolled, to be a CPA, and a CPA has a broader understanding of accounting as well. So you're going to need a CPA to help you, at least from an accounting standpoint, understand different transactions and everything instead of, someone specifically focused on just your tax return. So that is the CPA. But then even that, and this is coming from a CPA, even that is still not enough. It's still not enough. So just because someone's a CPA doesn't mean that they know what they're doing as it relates to business and investor
Mm-hmm.
taxes. So on top of that, I had to create a category because there's none out there. So the category I created is the tax elites. So the tax elites are individuals. Well, it's an acronym, so I'm really big on acronyms. So the E stands for education. So as you're looking to work with someone,
Mm-hmm.
you want to make sure, do they have the education to do this? Do they go to school to be able to learn this information? Again, school is not everything, but it just shows someone, it just, to me, that kind of shows your commitment to the craft, the profession, versus someone who's coming in there
Right.
just trying to make some money on the side during tax season. So education, did you actually go to school for this? The next part of that is L, legal representation. So can they represent you in front of the IRS? So what happens sometimes is,
Wow.
so what happens sometimes is, in the event that you get audited,
Uh-huh.
you may, it's highly recommended, you can't do, I mean, you're allowed to do it yourself, but you shouldn't do it yourself, because it's like going to court without an attorney. So if you get a letter from the IRS and they say you owe taxes or whatever the case is, then
Mhm.
you want to make sure you work with someone who could represent you in front of the IRS. So enrolled agents and CPAs could represent you in front of the IRS. So can tax attorneys as well. So someone who's a tax attorney could represent you from the IRS. So that's another thing. The next part of that is I. So it's a two-part I. So the first part of the I is integrity. So you want to make sure that you're working with someone who follows the tax code legally and ethically, abides by the tax code,
Mhm.
is not willing to take any illegal shortcuts in order to do that. There's 70,000 pages in the tax code.
Mhm.
80% of it is actually showing you how to save money on taxes, believe it or not. There's like a small section that's telling you this is the list of everything we consider income, and all these other rules are telling you how you don't have to pay this income.
Are you serious?
Yes. A lot of people think that you're it's all about them taking money from you, and trust me, they're taking money from you.
Yes.
Don't get me wrong, that's what they do, but all they really do is they have a long list of everything that's income. All they have to do is
Mhm.
list it out. If you make interest, that's income. If you work a job, that's income. If you have a business, that's income. Da, 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 da. So
Mhm.
that's the list, and everything else is telling you expenses, exclusions, deductions, credits, all these other ways that you don't have to necessarily pay this income.
Wow.
Yeah,
The truth will set us free.
it
So
it will. So
so we really could just look at the tax codes and be like, "Okay, I get it. I can start a business just from seeing all this." Like, you could get a business idea just from
that's what it is. Yeah, exactly. And that's why so many people, that's why it's important not only from, tax perspective, but also again going back to generational wealth,
Mhm.
like, using
Yeah.
business ownership is key, because unfortunately, for whatever reason, not my rules, the government's rules, they don't value the W-2 employee as much. So they're pretty much
Right.
they're not really giving them anything. You could, if you're a W-2 employee, you're not investing, you're not in business. Really, you're pretty much limited to contributing money into your retirement account,
Mhm.
itemizing your deductions,
Mhm.
and potentially getting credit for your kids. And then
Wow.
your home too. If you own a home, then
Yeah.
they give you a
Okay,
little break
so
there.
we got the E, the L, and the I,
Yep.
the T.
The T. So the T is training. So how much training is the individual doing?
Mhm.
So as a CPA, I'm required to take continuing professional education credits every year. So that's important. So making sure that you're working with someone who is constantly training and educating themselves, and that's required to do that. And then also too, above that, I'm spending a lot of money to continue to get trained and learning about all the different things that are coming out with the tax code. So like we recently just had that economic relief bill that came out. It's several thousand pages. They had Congress try to sign that within less than 24 hours, meaning that no one read that thing and just signed it and passed it.
Yeah.
Unfortunately, so that's just what it is. But to really be able to digest it, figure it out. Again, I continue
Mhm.
to train and learn up on what's going on with that. So that's another part of it. And the last part of that is experience. So you definitely want to work with someone who has experience in your particular niche, or someone's also been in the industry for years. So you want to look at years, and you want to look at experience types. So years, I think 10 years is sufficient. I've been in the industry for over 10 years. And then also too,
Mhm.
niche types. So does the individual have experience working with real estate investors? Do they have experience working with people in whatever particular industry that you're in? Because again, there's certain rules that come into play. There's different nuances, and it's always good to work with someone who has the deep understanding, because again, no one, I don't think, fully comprehends 100% of the tax code. So it's really making sure that you work with someone who is like keenly aware of, has a deep knowledge in either your particular niche or field, and obviously just a general overview of the tax code.
So if we ever receive an audit, what is the first thing we should do? Should we go ahead, or okay, there's a difference between, I've seen family members receive a bill saying that, "Oh, we looked at your taxes and you owe us $5,000." That's not the same thing as an audit, is it?
Yes. Potential. So basically, there's different ways that you get audited. So you can have the letter in the mail that's saying that, hey, we want you to prove that these expenses are real, or that you have the supporting documents behind that. There's other
Wow.
audits. Yeah, there's another audit which is just related to, hey, you haven't done your taxes. What's going on? You're in trouble.
Mhm.
Then you have another audit. They can actually do what's called like field audits and office audits, to where they actually show up at your place and have you sit down and show us, okay, what's going on. That's rare, but just putting it
Uh-huh.
out there. So that's another type of audit. So all an audit is again, like, they have most of it's computer
Mhm.
generated, and it's just really looking through and your tax return, seeing if anything looks off or funny. So like round numbers look suspicious, because nothing in life is really is round numbers. So if you're saying
Right.
that, you spent, X amount on, like, you spent $50 on gas or whatever the case is, they'll be like, okay, yeah, right. You know what I mean? Um, so that's one thing. Another thing that throws them off is if, like, your numbers aren't matching. So let's say you have W-2, you put in
Mhm.
that W-2, and it's different from the actual W-2, then that's gonna raise a red flag. So there's different things. Having huge expenses that don't necessarily relate to your business or industry,
Mhm.
that might throw them off. So yeah, those are different types of audits. So yeah, the first thing that you need to do is you want to get the letter, and I would highly recommend you contact, the tax elites, as I mentioned, and get on the phone with them and see if they, help have them work through and help you out with your situation. See
Mhm.
if if it's a significant amount, then you might be able to do what's called an offer and compromise, where you can have, and tell them that, hey, this, I can't pay this, but I can pay this. So
Right.
that could be a potential thing that you can look into. And then also, too, another thing that people don't realize is, 80% of the people who end up losing an audit is just because they didn't respond. So like, even if you can't pay it, people are,
They
yeah,
shut down. It's like, I can't do it.
yeah, they see the numbers, like, I'm not gonna
Yeah.
respond, ignore it. Do not ignore it. Respond back. Let them know it's like, I got it. Thank you. I'm working on it. I'm trying to figure some things out on the background. But even if you can't pay it, respond, because that's just gonna it's gonna get them upset. So make
Yeah.
sure you respond back. And then, yeah, again, working with that professional to kind of walk you through your different
Mhm.
options. You might have to do a payment plan. That's an option, but just making sure that you do it. But yeah, but the most important thing is proactively making sure that you're doing the right things to not trigger an audit.
Okay. So, how do we know which type of prepare do we need? Is it based upon our income, what industry we're in, if we're investors, or like, how do you know if I know I don't need a tax preparer.
Yeah,
Definitely don't need all the stuff I have
no,
going.
you're
But how do
beyond that. Yeah.
but how do you know if someone's listening, okay, well, I'm a teacher, or I just work a basic 9 to 5, I have just one property, that's I'm a landlord for one property. How do you know what you need? Like, what would that person need?
Yeah. So the way I see it is, if you're just a W-2 employee making less than 100,000, I think a tax preparer is fine. You could either self-prepare,
Okay.
like doing on TurboTax, and or work with someone like at H&R Block to do your taxes, because your situation isn't super complicated.
Mhm.
I personally recommend all business owners and investors to get someone who's in the tax elite, because there is, like, talking about hundreds of ways
Mhm.
that you could save money on taxes, and there's no way that you can even figure it out. Again, and even CPAs are not even aware of everything that's out there. So just making sure that if you're a business owner, investor, making sure that you're working with a professional that's in the tax elite. And then, yeah, that's really the two key distinctions. Like, if you're just going to be a W-2 worker all your
Mhm.
life, and you probably make less than 100,000, then it's fine. If you make more than 100,000, there are certain things that you can do, certain creative things that you can look into, but that's pretty much where you're at.
So, I got a question I want you to what is it? Demystify,
Yes.
this idea. Are we supposed to be getting a tax return?
You mean a tax refund?
Yeah.
So the tax refund is just an overpayment that you made to the government. So generally speaking, it's better to be even. So you um pay the government exactly what they're owed and just kind of be square off that. It is difficult to estimate because you're making you're making money throughout the, especially as an investor or a business owner, you're making money through the year. It's hard to estimate. So but yeah, I mean, if you get a refund, it's not a time to just jump up and down and celebrate, because you may be you that just means you overpaid to the government.
Okay. So are we supposed to be writing checks every time we do our
Yeah.
taxes?
So if you expect to make more than $1,000 in profit from your business, then yeah, you should be making what's called quarterly payments. The way that you can do that is, one, you want to estimate how much money how much money you are projecting to make for the quarter. And then
Mhm.
typically a safe number to use is maybe like 30%, so you pay 30% of that to the government as a quarterly payment. Another
Okay.
rule that you could look into is what's called the safe harbor rule. Basically, what
Mhm.
that is if you just look at your prior year tax return, if you pay over 110% of what you owed last year, then they will accept that kind of as a as a payment. Here, my nephew. But if you go ahead and pay that amount during the year, then you can avoid fines and penalties.
Got it. Got it. Okay, so if we were going into, I guess, going into a strategy
Yeah.
like the 1031 exchange,
Hmm.
is can you explain that? Because that is also another tax a strategy that we could use to save money along with, the what is it called?
Home exclusion.
The home exclusion. See, I've never even heard of it, the home exclusion. That's why it's like a new term for me because we always said it was the fix and live.
Oh.
So that's a new term, the home exclusion.
That's
So
that's that's a technically correct term to use. The fix and live is, it is what it is, as long as you meet the rules and requirements. But the idea, I'll say this, and this is what a loophole is, by the way. So loophole is
Mhm.
just using what's out there in the tax code and then using it to your advantage. That the fix and live, I think really the purpose of the home exclusion, like I said, is to not deter people from being a homeowners. The fix
Right.
and live, I don't think that was the original intention,
Right.
but if you use the tax rules, which there is a rule to do that, then you can do that. So it's cool.
Mhm.
But yes, 1031 exchange, that's huge. So 1031 exchange, the way that works is, we talked about capital gains tax. You sell a property for more than what you paid for it, you have to pay capital gains tax. The
Mhm.
1031 exchange, what allows you to do is take the proceeds from that gain and reinvest it into a like kind type property, pretty much a real estate investment of the same value or greater. You go ahead and take those proceeds and reinvest it into another property. The thing that you need to understand, and this is why it's important to work with a tax elite and someone who is aware of this, because it's really, it's not as simple as you just taking the money and reinvesting into another property. You have to be aware of the timing considerations as well. So one,
Yeah.
you want to work with the intermediary on that, right? So you
Mhm.
find an intermediary, and they're responsible for pretty much holding on and managing your money. So you want to identify the property. You let the intermediary know, look, I found a property. You have to identify that property within 45 days, and then you have to execute on that deal within 180 days, and that will allow you to be able to do the 1031 exchange. And again, the intermediary is going to be the one holding on to the money
This is
and
the
then
attorney.
reinvesting. Intermediary, so it potentially could be an attorney, but it's just a middle
Mhm.
person that's going to be responsible for holding on to that money for you.
Okay. Okay, I've seen it happen in one transaction, and I thought it was just incredibly cool. I was the representing the buyer, and the seller was doing a 1031 exchange, and they were making a lot of money. And it was amazing to me because it was parents, and they were showing their kids how to do it. And so the kids were at the closing table,
Oh,
and they were like, "Dad, Dad, I want to see the check." And they were like, "Well, you're not getting a check," and they couldn't understand it. And
uh-huh.
he's like, "No, son, somebody's holding this for us. You're not gonna see it because we gotta go to South Carolina and do another property." And they were just like, "Wait a minute. we did all this for nothing. Like they had not even heard of this before. And they were like, this is a 1031 exchange. And they were just like, I still don't get it. I did all this and we're not getting a check at this table. Like,
It's yeah, an incredible benefit and strategy. And yeah, like to your point, again, making sure that you know it beforehand is going to be key, and then you can continue you can do that indefinitely, so you can defer, and you pretty much, this is one of the ways that Donald Trump was able to reduce how much money he pays in taxes, because he kept just, every time he buys a property, he reinvests into another one. He doesn't have to pay taxes. You could do that until the day you die.
right.
One thing to keep in mind, which is not so great news, but with President-elect Biden, he's actually looking to get rid of the 1031 exchange as one of the, yeah, I know.
Say it isn't so. Are you
Yeah.
serious?
Yeah, because and this is a quick thing to bring up. So yes, President-elect Biden, he's coming in, and one of the things that he's looking to do, he created a proposed tax plan. He's looking to increase the tax revenue by $2 to $4 trillion, to again, for the government to be able to collect revenue, and then also kind of help with the deficit. So one of the things that he's looking to do is to increase taxes on individuals making over 400,000, and then also to closing and shutting down some of those tax benefits and incentives. So the 1031 exchange, something on the table that they're looking to get rid of, because the 1031 exchange, in his opinion, is not going to be used by the average American.
No.
This is used by the rich people.
The rich.
All right. So he's like, well, you guys make enough money, you guys need to contribute. So this is a way that we can have you guys give more money to the government. So that's one thing. And they're also looking to actually increase the capital gains tax as well, for people making over $1 million. So yeah, it's
wow.
it's a couple of things. So yeah, definitely being aware of the tax code, and knowing about, some of the rules that are coming up is going to be key. But yeah, 1031 exchanges could be a thing of the past.
Yeah. Do you think he's getting rid of, well, not do you think, because you've already been reading and studying. What about the opportunity zones?
The opportunity zones, he's probably going to get rid of that too. Just opportunity zones, I believe, was put in place. Well, opportunity zones, I believe, is supposed to expire 2036. So that might be around. But yeah, basically, so when Donald Trump got into office, he created this huge tax reform, the Tax Cuts and Jobs Act. And I believe the opportunity zone credit was one of the ones that he included in there. So basically, when Biden gets into office, he's looking to revert all of that and just undo it. So, and this is another thing to consider too. So historically speaking, usually when a president is trying to get a bill passed and proposed, they usually, the years where they actually get to do it is when they have the House and Senate. We know that now, given the Georgia election, the Democrats have the House and Senate, so there's a very strong likelihood, probably 90% chance, that whatever he proposes with that tax plan is going to be,
it's going to go through.
Yeah, they're just going to sound like, yep.
So do you see any benefits for us with the Biden, as far as in saving in taxes?
Yeah,
in this Biden administration?
Yeah, so yes, but it's really benefiting lower income individuals. Fortunately, and potentially unfortunately, depending on where you fall into that, right? So if you make less than 400,000, he's promising that he's not going to increase your taxes by a cent. Another thing is that they are increasing and extending the benefits of child tax care credits. They're looking to also increase and expand the earned income credit for individuals who are making less than, I think it's 40,000 or something. They're also opening that up to older folks as well, because typically I think you would have to have children to be able to qualify for it. They're also creating a benefit for homeowners. So they're creating a tax incentive for first-time home buyers. So I believe they get a tax credit for doing that. So there are some benefits. It's not all bad. But as far as a business owner and investor, he is not. Those individuals are not on his priority list to be able to save money on taxes. He's actually looking to get more tax money from them, because he believes that they can afford it. So this is Biden, not me, that's saying this. That's what we believe. So again, this is just me stating facts.
Yeah, but still, even with this new administration, do you still see the benefits of owning real estate?
Oh yeah, no, for sure. So even with the new administration, it's not like they're going to get rid of all of the tax benefits for homeowners. I'm sorry, for investors and business owners. So that's still going to be a huge benefit to the country, huge benefit to society. So that's not going to go away. The thing that's going to go away is some of those really high level, like the things that the generally speaking the multimillionaires do, and ways that they can, reduce their tax liability. So
Nice, nice. So, are you excited about the new Biden administration?
yeah, I think it's exciting. I think personally for me, there's been just a lot of things going on in this country, and I think it's exciting to see, what potentially could come out of, everything that's been going on. I mean, if you look at the pandemic,
Mhm.
and how a lot of this turmoil in 2020 has been like a crazy year. So I think it's exciting to be able to see, a new administration, see what they can do. But then more importantly, I think I'm just, always excited about continuing to look for new ways to grow and help more people too. So this is honestly, in a selfish way, this administration is probably going to get me a lot more clients because of all the changes that are coming up in the tax code, honestly, right? Because
Right,
now tax planning is going to be more important than ever. Like, so when Trump got into office, he was actually looking to reduce taxes for everyone. This
right.
administration is looking to increase taxes for a lot of people. So tax planning is going to be more important than ever. So if it's something that you've haven't considered, you definitely want to consider it now, because
Mhm,
we didn't even get to go into all the things, but he's looking to increase the corporate tax rates. It used to be 21%, now it's going up to 28%. The federal tax rate, this is just for individuals. He's looking to increase that. I think the highest before was in, I think, 32 or 35. Now he's looking to increase
mhm.
by 37, 39. So there's going to be a lot of changes. So it's definitely good to get that proactive, you know, working with that tax elite. If you're interested in working with us, you can reach out to us on valbrungroup.com. So
Mhm.
VALBRUN group.com. I'm also pretty active on Instagram. So if you follow me at Michel Valbrun, so MICHELVALBRUN, you can be able to, check me out. I create a lot of free content. I have a course actually called Tax Wealth 101.
Tell us about that course.
Yeah, that course, it's a course that I put together, extremely affordable, costs less than a tax prep. So you're going to, in that course, it's a 6 module course. I'm literally breaking down everything from like the foundations of tax, how
Mhm.
business and owners and investors can save money on taxes legally and ethically. I go over like, I think at least 20 strategies in there, talking about like, we'd even get to talk about deductions, how you could be able to write off your
Yes.
deductions. I go into even for a stock investor. So if you're
Mhm,
investing in the stock market, how you can do that. Another important concept that I want to share with you guys really quick before we wrap up is, if you are on the passive side, like if you have residential property, you cannot take the full amount of those losses against your active income unless you are what's considered a real estate professional. And we talk about that, like you have to be able to qualify as a real estate professional. The threshold's kind of high in order to do so. But if you are a real estate professional, you can take all those losses against your other income. If not,
uh-huh.
then you're limited to how much of that you can write off.
So you say a real estate professional, you mean like you have to have a real estate license or property management certification? What do you mean by that?
So it's based on the amount of time and effort that you
Mhm,
are. One of the requirements is how much time and effort that you are in the real estate profession, meaning that, for myself, I'm not a real
mhm.
estate professional. I have an accounting firm business, but with my properties, because I'm not a real estate professional, I can't deduct the full amount of that. I'm only limited because that's not what I do. But if this is what you do, like you have a construction company. If you are
Got it.
if you are they call it material participant
Mhm.
in real estate, then you're able to get more tax benefits or be able to, carry over those losses to to your personal income. So that's
So do you prove that with like your LLC and your checking account, which you mentioned earlier?
no,
No?
that's not. It's a bar. It's a pretty high bar. Basically,
Okay.
they need to believe that this is what you do as pretty much your main business. Generally,
Got it.
they keep it.
Like they go to your website and they see your company as well?
That's
Or I'm still not even touching the
you're
surface.
not even getting, like, we're talking about like
Wow.
hours. So you want to track how many hours in the year that you're spending, like looking at your properties, uh, researching properties, traveling to properties, fixing properties. So like usually, if you are in the profession, like maybe it's easier as a real estate agent, it's easier as someone who has a construction company, it's easier for someone who is does renovations, it's easier for someone who has a management company to be able to
Mm-hmm.
qualify for that. But again, it's a very high threshold, but it's not like as simple as creating an LLC, putting on a website, business cards, Instagram. Like they want to see what's called material participation in real estate. So
Is
but
this something that we need to try to achieve or get? Yes. See,
yes.
nobody talks about this. I need to have you
No,
back.
that yeah, no one
Why
talks
don't we
about
know
this
about this?
because people. I already I told you the whole podcast. CPAs don't talk about this because they don't know it.
No.
They don't talk about this in school. This comes from knowledge, experience, training. Yes, this is a real life thing. This is huge. And like I said, I talk a little bit. I touch on it in the program,
Mhm.
but I just want to put that out there because yeah, no one talks about it.
And it's real estate professional.
Look up real estate professional tax, and your mind's gonna be blown.
And this is a whole new level of saving money. We can make more wealth if we just get to this threshold
Yeah,
of being a
well,
real estate professional.
all it is, so the IRS makes a distinction between active income and passive income. So
Okay.
let's say you're in the stock market and
Mhm.
you're investing in stocks, but you have a full-time job. You're selling stocks on the side. Your stocks has a loss. You could
Right.
only deduct up to $3,000 of your loss against your other income.
Mhm.
So they make a distinction. But if you consider what's called a real estate, or sorry, if you consider a trader instead of an investor, then the trader could be able to take off the full loss, and they can take off business deductions because that's their business.
Wow.
Yeah, it's a
Wow.
lot. But like I said, check me out, follow my Instagram,
Yeah.
book a call with me. And yeah, we can go through all of it. But no, this is
Yeah.
it's life. And like I said, and the thing about it is you don't know what you don't know. Like
Yeah.
it's so much information out there, and just like yeah, I think I get it. Real estate, taxes, yeah, income, expenses, da da da, schedule D. No, there's
Mhm.
like a whole different world universe.
Okay, and so we could just go to the irs.gov to get access to the 70,000 pages of the tax code?
Yeah, it's all there for you for free. It's just
Mhm.
are you going to be able to understand and interpret it? And chances are there's a high likelihood that the answer is probably going to be no because they put it in legal language. They
Mhm.
don't break it down. They're not giving you the elite or acronyms and some of these other acronyms that I tell people.
Yeah.
They're not breaking it down in a way that it's easy to understand. So
Mhm.
yeah, I think having someone working with someone to interpret it for you, yes, it's good. But then yeah, you could look up the real estate professional, but there's probably like pages and pages that you got to read instead of someone just telling you like this is how many hours that you need to work. This is our different companies and industries that generally are able to qualify for it, blah blah blah.
Mhm.
Like they're
So
not
let me ask you, is
laid out
to
like
be a real estate professional, is this something that we need to plan for 2022? Is it too late for us in 2021 to be a real estate professional?
no,
No.
yeah, not too late.
Okay, I need to get you back.
It's not,
We gotta talk about that. I had no idea because
yeah,
it's more like, yeah. Yeah, 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 yeah.
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 You like I said, you wouldn't know. It's like you don't know what you know, and then and there's a lot more. It goes deep, but anyways, but yes, no, it's been a pleasure. Really appreciate the opportunity. Again,
Yeah.
guys, if you guys are interested in getting more information, definitely check me out. And yeah, part two
Yeah.
sounds like it's gonna be coming.
Yeah.
So
It's coming. Yeah. And for those listening, you can get all of his information, social media contacts, his website, his course. It'll all be on lightinguprealestate.com. To learn more about Michel, just go to lightinguprealestate.com. If you like this episode, subscribe, leave a review, and share this with someone else who needs to hear this interview. That's all for now. Stay safe, stay sane, and stay lit.